Hello and good evening. Today we'll discuss once again on cash from operations, but in this session we will try to take the balance sheet or the annual report of one of the well-known Indian companies, that is Wipro Ltd, and understand why is the profit not same as the cash from operation of. We know that cash from operation is not same as profit because of non-cash items like depreciation and amortization, because of non-operating items like dividends and interest, because of credit items like the changes in the debtors, creditors and the stock. So we'll see why the profits of Wipro profit of Wipro for the year ending March 2011 is not same as the cash from operation. Let us go to the annual report of Wipro and see the profit. The profit of Wipro for the year ending 2011, the profit before tax is 57,055 million and profit after tax is 48,437 million. Whereas the cash from operation, is 37,105 million. That is around 70% of the profit is cash from operation. So why is this cash from operation different from the profit? So let us put that items in the Excel and understand. So we know that cash from operation is not same as the PAT because of non-cash, because of non-operating and because of the working capital. And the relevant items picked up from the annual report of Wipro are given here. So we'll try to reconcile and find the CFO from the profits. So profit after tax is a profit before tax minus the tax paid. So this is the profit after tax, adjusted profit after tax you can say. Then we'll find out the non-cash, non-operating and the changes in the working capital. So we'll pick up one by one item and understand. Profit from the sale of assets which has been included is a non-operating item. So profit from the sale of has to be deducted while computing the CFO. Profit from. The profit from the sale of investment is again non-operating, so therefore that also has to be deducted while computing the CFO from the PAT. Interest on borrowing has been shown in the income statement while computing the profit, and interest is a financing expense, not an operating expense, so interest will also be adjusted, but in this case interest will be added back because interest was an expense while computing the profit. Exchange differences, and that too loss or the losses due to the exchange difference, that means foreign currency difference, which has been shown in the income statement, is a non-cash item. So non-cash item, and it has been deducted, so we are going to add it back. 804 add. Increase in inventory is the working capital change. That means you purchased the goods but not used in this period, so therefore that has to be added back in the computing the cash flows. And we have seen in the past one of our sessions why increase in the increase in the data, increase in the inventory and increase in the data have to be deducted because you have not used during this period. Amortization is a non-cash item, and while computing the profit it has been deducted, so therefore I'm going to add back the amortization. Increase in the current liability, that means you have paid money, you have purchased goods on credit, so and you have not paid money to that extent, so it is a cash inflow. Increase in current liabilities. Impact of the cash flow hedges, and that to a non-cash item and a loss. So non-cash item and a loss. So just like exchange differences, it will be added back because it's a non-cash item. Quite a huge amount is a impact of the cash flow hedges. Depreciation is a very popular non-cash item shown in the income statement, so that should be adjusted by adding it. Dividend and interest income is a non-operating income, and since it is non-operating income, while computing the cash from operation, they are deducted, and so 6,234 will be deducted while computing the CF. Increase in the loans and advance is another current assets. So increase in the loans and advances is another current asset. Increase in the current asset is a decrease in a cash flow. Tax paid we already taken. Increase in the sundry debtor is selling goods on credit. So therefore, when you are selling goods on credit, you are not getting that much of cash. So all the items, so since you're not getting the cash, so that has to be deducted. So if you make these adjustments, all of them together, and you get the cash from operation, which is given in the cash flow statement. So the as discussed in one of our previous sessions, the cash from operation is not same as cash the profit because of the non-cash, because of the non-operating, and because of the changes in the working capital. So PAT is different from the operating cash flows. So the operating cash flow is around 65%, of the profits. So operating cash flows are 65% of the profit before tax, and the profit before tax is not same as the CFO to a large extent because of the credit transactions in this case, and particularly huge amount of debtors sitting on the balance sheet. So to go back, we have mentioned that the cash from operation in any case, in any organization, is not same as profit because of these three items, and that is precisely what we saw in case of Wipro too. So Wipro's cash from operating activities is not same as the profit from the business because of non-cash, because of non-operating, and because of the credit transaction. And this principle remains same for all the corporate or non-corporate entities, that the profit will not be same as CFO. Thank you very much.